Over the last few years, meme stock mania, crypto hype, and flashy social media marketing convinced millions to open brokerage accounts. They log in, staring at flashing numbers, searching for an algorithm or a strategy they hope will produce immediate, effortless wealth. Most newcomers treat the financial market like a mechanical system. They assume if they draw the right lines on a chart or consume enough news, they can predict exactly what a stock will do tomorrow. This visualization shows the reality behind that fantasy. According to data from the European Securities and Markets Authority, between 74 and 89% of retail accounts in leveraged markets lose money. Another 5-year study by French regulators tracked retail traders and found an 89% failure rate, with an average loss of nearly 11,000 euros per person. Elite mathematical minds and professional institutions are equally vulnerable to these collapses. In 1998, Long-Term Capital Management, which was a massive hedge fund run by Nobel Prize-winning economists, suffered a $4.6 billion collapse. Raw intelligence is not a shield against market shocks. The global market is a complex, highly adaptive system, driven by millions of overlapping, unpredictable variables. No trader, institution, or algorithm knows with 100% certainty what will happen next. Success in this modern environment requires the ability to manage the consequences of uncertainty, rather than simply attempting to forecast it. The amateur trader is obsessed with a single question: is the price going up or down? The professional asks something completely different. If scenario A happens, how much do I make? And if scenario B happens, exactly how much do I lose? Look at this comparison to understand the math of expected value. On the left, a single spin of a roulette wheel is completely random. But on the right, across 100,000 spins, a casino's built-in 52% edge creates a smooth, highly predictable profit curve. The casino doesn't care who wins the next hand, because they rely on the law of large numbers. In the markets, your trading system is your edge. You can actually lose more often than you win and still generate massive returns. Many of the most successful trend-following friends win less than 40% of their trades. Because they cap their losses at $1 and let their winning trades run to $3 or $4, their overall math guarantees a profit over time. Generating consistent wealth requires detaching your ego from the outcome of any single trade. A professional views an individual position simply as one tiny data point out of 100, trusting their mathematical edge to do the heavy lifting. Once you establish an edge, the next trap is how much money you put on the line. To turn a small account into a large one quickly, amateurs use heavy financial leverage. But leverage is a double-edged sword. It amplifies the smallest opposing price swing into a devastating account drawdown. This chart maps out the brutal, non-linear math of recovering from those drawdowns. If a $10,000 account drops by 50%, you only have $5,000 left. To get back to your starting point, you don't need a 50% gain. You have to generate a 100% return on your remaining capital. If you suffer an 80% drop, you need a 400% return just to break even. We can see how this plays out in real time. Trader A takes heavy risks with no safety net. They double their account in a month, feel like a genius, and then a single bad week wipes them out completely. Trader B risks a maximum of 1 or 2% per trade. Their equity line looks boring, but by avoiding deep losses, their capital compounds steadily year after year. And you cannot assume your software will always save you. In January 2015, the Swiss central bank unexpectedly removed its currency peg. In a matter of minutes, the franc surged 30%. Market liquidity completely evaporated. Traders' automatic stop-loss orders failed to execute because there were no buyers, leaving thousands of retail accounts with massive negative balances and bankrupting several major brokerages. Limiting risk to 1 or 2% of capital is the mathematical requirement for staying in the game. It allows the account to survive black swan events and gives a statistical edge the time it needs to generate returns. The math of risk management is simple on paper, but human psychology creates a final, invisible barrier to success. Behavioral economists have documented a bias called loss aversion. The fact that humans experience the pain of losing money much more intensely than the pleasure of making it. When a trade starts moving in the wrong direction, an amateur's instinct is to reject the loss. Instead of cutting the trade at a calculated 1% risk, they hold on, hoping the price will bounce back. As the loss grows, panic sets in. They start revenge trading, doubling down and adding leverage to a bad position to force the market to give their money back. The financial pressure mounts until the trader's emotional framework snaps. They abandon their trading plan entirely, acting purely on fear and desperation, ending in the total liquidation of their account. Trading is a daily, relentless battle against your own ego. A professional views a planned loss as a routine business expense required to keep the doors open. The loudest voices on social media sell the myth of the adrenaline-fueled trader, racking up massive daily profits. Real institutional professionals operate like accountants. They are patient, process-driven risk managers who spend the vast majority of their time simply waiting for the exact conditions that match their statistical edge. Institutional wealth is generated through consistent compound growth, typically targeting realistic annual returns of 15 to 25%. A trader claiming they can generate 100% returns every month is taking on hidden, catastrophic risks that guarantee eventual ruin. Look at Warren Buffett. He built one of the greatest fortunes in human history not by making wild, leveraged bets, but by maintaining an average compound annual return of roughly 20% over 5 decades. Or look at the Medallion Fund, founded by mathematician Jim Simons. His elite quantitative algorithms didn't rely on massive individual wins. They established a tiny statistical edge, winning just over 50% of the time, and executed it millions of times with ruthless mechanical consistency. Sustainable wealth is a marathon powered by compound interest and strict risk control, not a sprint driven by leverage and luck. If you want to survive the great filter of the financial markets, you have to build your process on 4 unchangeable pillars. First, probabilistic thinking. Accept that every trade is a random draw and you cannot predict the future. Second, scientific risk management. Restrict your exposure on every single trade to 1 or 2% and defend your account from steep drawdowns. Third, psychological discipline. Neutralize loss aversion and strictly execute your plan, even when a streak of losses tempts you to break your own rules. Fourth, realistic expectations. Ignore the marketing noise, accept modest, consistent returns, and let the math work for you over the long term. The market is a neutral machine. It only mirrors your own discipline and emotional control. Stop trying to guess what happens next. Write down your risk parameters, accept the uncertainty, and focus entirely on surviving the next 100 trades.